ChatGPT is a hero that we perhaps don't deserve, but definitely need. Big tech firms don't remember the year 2022 kindly. This is when major tech players lost billions of dollars in the sloppy stock markets until OpenAI did something powerful. In 2023, the future of stock markets lies in the hands of AI-exposed tech firms, and it's a game changer. In this video, we're breaking down the recovery of the tech stock market slump, the transcending power of AI-exposed share price, and the potential harms of AI bubble. But before we start, like this video and subscribe to our channel. The year 2022 was profoundly turbulent for tech firms in the United States of America. Major market shareholders like Apple, Microsoft, Meta, Amazon, and Tesla lived through huge devaluation of their stock. Companies that have racked up billions of dollars in stock market surges and consumer demand were struggling to fund their ambitious projects. The losses were immense. In particular, Meta lost 2/3 of its value, while Amazon lost half of its value. Such numbers were daunting and highly reminiscent of the 2008 crisis and the bursting of the dot-com bubble in 2000. By all means, the tech industry was living through the third worst year of their stock performance and money-making gimmicks. Overall, tech stocks plummeted by 30% in an all-time low statistic. After a terrifying turn, the Dow Jones U.S. Technology Index was down by 35%. This particular index tracks the performance of the U.S. tech companies in the stock market, just like NASDAQ does. And speaking of NASDAQ, this particular tech-focused index was also down by 33%. And of course, more losses were to come. In a shocking revelation, the crypto industry dropped as quickly as it had gained momentum in the preceding year. Bitcoin and Ether, the crown jewels of the crypto world, also lost 60% of their total value. The crypto-infatuated faction was in a complete meltdown. So, yeah, the tech industry was in a slump. And the implications were huge. Many companies moved forward to lay off thousands of their employees to make up for the stock market crisis. Simultaneously, many firms were pushing their mega projects under the rug while they navigated the dangerous territory of the stock drop. Now, the reasons for such a turbulent year are fairly obvious. The war in Ukraine had put the world on a back seat with no way out. As a result, inflation was skyrocketing. To tackle that particular galvanizing impact, the Federal Reserve exponentially increased the interest rates exponentially. And of course, the tech companies weren't happy. They had gone from racking cheap money from zero interest rates to losing a major cash crunch. Even the investors sought quick cash generation instead of putting money into the tech firms. Times were hard and certain. But then, investors changed their minds. They went back to their roots to pour money into tech firms and live off optimized stock performance. Very quickly, the tech stock market domain became the spitting image of it was the best of times. It was the worst of times. So, what changed? We have one word for you: ChatGPT. That's right. When Microsoft-backed OpenAI launched its first sophisticated artificial intelligence tool, the stock market entered a new epoch. And let's just say lives were changed. Finding the video informative? Subscribe to our channel. There's no reason to deny that we're living through our future today. For decades, tech experts have wished for an unprecedented boom in the stock value of robotics and automation. The ChatGPT breakthrough tells us something insightful. Investors want to readily make money from the sudden AI popularity. Buy the hype or not, stock market experts are readily encouraging big and small investors to accept our mystical reality. AI is here to stay. By the looks of it, major firms like Google, Microsoft, Tesla, and Apple have also gotten the wind of the new face of technology. And to appease their investors, these companies are making major strides in product development that are both safe and risky. Virtually, firms are the most radically successful and colossal flops. While Microsoft took the cake by making focal investments in OpenAI, Google's Bard ended up financially damaging the company. It's safe to say that tech firms are still navigating their way into the AI market, and their financial losses are a small price for the long haul. Very simple yet robust statistics would show you that AI-exposed firms were able to appease investors pretty quickly. And this is exactly why such firms started to gain momentum in the stock market overnight. As it stands today, the overall valuation of tech companies has improved significantly. S&P 500 index shows optimistic tidings for the AI boom. The biggest winner of the almighty surge is none other than NVIDIA, which recently became the first tech company to lock in $1 trillion with its AI exposure. This particular case in point tells us something interesting. The stock market has welcomed industries that were quick to diffuse artificial intelligence in their operations and products. But more importantly, firms that facilitate AI powerhouses like Microsoft are in a league of their own. You see, the sudden bloom in the stock market prompted companies like NVIDIA to drive a competitive edge in their computing chips and AI software, two focal ingredients of any artificial intelligence system. As the Californian company was able to tap into this particular demand, its share price has risen by 23% in the current year. That's a 2x increase in its share price as compared to the slump from 2022. In the blink of an eye, NVIDIA is the coolest kid in the stock market, and everyone wants to be in its empowering company. After all, the humble graphics card company is now the 5th most valuable corporation in the United States of America, and it's still growing exponentially. So, if stock market gurus are compiling comprehensive lists of the best AI shares to buy in 2023, they aren't living off some shady clickbait. For once, they aren't making weak predictions about investing in Alphabet or Adobe. To be fair to our stock market bros, buying AI-exposed shares has been fruitful so far. In the status quo, companies like NVIDIA, Google, and Microsoft are faring well, but all eyes are set on OpenAI. It's almost baffling, but the impetus behind the AI boom is still private. Despite banking heavily on the success of ChatGPT, OpenAI hasn't made any announcement for an initial public offering or an IPO. We couldn't have imagined this 10 years ago. But major investors are waiting for the IPO to go live so they can invest in a tech firm that is an expert in an AI-based chatbot. While the company is valued at over $30 billion and has 200 million users, it still lists itself as a privately owned AI research think tank and nothing else. But even its humble self-description isn't effective in slowing the frenzy for its stock market entrance. The truth is that investors are eagerly waiting for OpenAI to go public. Now, if that doesn't show you why the AI-backed stock market is our future, what else would? It's both interesting and frightening, but the boom in the tech stock market also had a major spillover impact on other non-tech industries. In a fascinating turn, the overall market capitalizations have improved significantly since November 2022. And if you recall, this particular time frame is strategically important for one reason only. That's when ChatGPT was launched and got immediate hype from its ardent users. All in all, the stock market, without its broader categorization, was able to recover from the 2022 slump. And that's a huge achievement altogether. This interesting pattern is a revelation of its own. We have to accept that the AI surge has more external impacts than we could have imagined. And of course, as much as everyone is welcoming towards the stock market recovery, we shouldn't ignore the implications of this massive boost. So, let's look at some valuations, shall we? NVIDIA's stock was up by 23%. OpenAI saw a surge of 36% in its share price. Botox gained a momentum of 30%, and more importantly, C3. AI saw a 156% surge in its share price. Now, we don't mean to be the bearer of the bad news here, but these numbers reek of an AI bubble. And if we've learned anything from tech firms is that when the stock market bubble inflates, the ramifications are huge. And nope, we won't subject you to the history of how the dot-com bubble saw its doom. Instead, we just point out something very obvious here. Even though the AI surge is important and has a lot of potential, the increasing valuations are perhaps too hasty. Look, it would be a stupid move to question the future of AI. It's here to make a mark. But experts are rightfully worried about how wise it is to make the only driving force for the tech firms that are pretty uncertain about their trajectory. Not to mention, many AI-backed projects are still pilot and preliminary. Their developing phase can make or break the stock market at the snap of your fingers. And of course, the case in point is Google's disastrous presentation of its overhyped chatbot, Bard. One wrong answer and whoops, Alphabet's stock plummeted by 9%. That's not a very good precedent to set. Plus, investors are easily infatuated with novel technologies, and when they lose their interest, the implications are pretty severe. At a certain point of the AI surge, we'd have to stop everything and assess its risk on stock market bubbles and its overall performance. But before that, make those money moves. Found the video insightful? Give us a like and subscribe to our channel for more content like this.